Hello viewers, this is Altaf Ismail, International Tax Practitioner. Today we are going to speak on International Transfer Pricing Regulations, Introduction and ALP. OECD has issued transfer pricing guidelines. Uh, for many years they have been issuing these guidelines and the current version in publication is January 2022. We are expecting another issue from OECD relating to TPG in 2025, which is expected to be there in 2025 June. Today we will discuss Chapter 1, Arm's Length Principle of OECD TPG Guidelines 2022. Arm's Length Principle defined in Chapter 1, Para 1.1 of TPG says this chapter provides a background and discussion for arm's length principle, which is the international transfer pricing standard that OECD member countries have agreed should be used for the tax purposes by M&E groups and tax administration. The chapter discusses arm's length principle reforms, its status and the international standard, and set forth guidelines for application. This is available on page 29. We will see Part D of Chapter 1 with the guidelines for the application of arm's length principle, and there is a separate dedicated chapter, Chapter 3 of TPG, which discusses the applications of arm's length principle. Our today's discussion will be based on the ground realities, how this international transfer pricing will be applied under the given guidance of arm's length principle and why it is necessary to adopt the arm's length principle. Traditionally, M&Es have always been categorized as a group entity working in multiple jurisdictions, and that causes some sort of distortions when the M&E group sitting in one jurisdiction charges one price which may not be arm's length, which results in one jurisdiction or the other jurisdiction to suffer. For this purposes, the OECD member countries have agreed to adopt this arm's length principle so that none of the territories should suffer an adjustment wherever required due to the M&Es being a group of countries may not consider. However, the tax authorities considering the third independent party transactions may incorporate the adjustment in both the territories affecting the arm's length avoidance. We will see how it's done in the subsequent discussion. There is a glossary available on page 19 of OECD TPG, which further describes arm's length principle, which confirms that it's an international standard that OECD member countries have agreed should be used for determining the transfer prices for tax purposes. This is set forth in Article 9 of OECD Model Tax Convention as follows, and it is very well replicated in OECD TPG page 19, which is Article 9 of OECD Model Tax Convention. In the subsequent presentations which are coming ahead, we will see the comparison between Article 9 and OECD arm's length principle given in TPG. Now, for the sake of illustration, we have created this slide. There is a IP license award by resident in country A to country B. Accordingly, the award of IP license will result in the payment of royalty. Here it's the control transaction between the two M&E group members, and this is an uncontrolled transaction taking place in the third party. There is no difference between the nature of transactions, rights, and the features awarded between the parties to the transaction, except this transaction is undertaken by the uncontrolled entities. It's called uncontrolled transactions, and as this transactions is being carried out between the M&E group, they are group member of the same M&E, so this is the controlled transactions. Country B is making royalty payment to country A. All the features, all the nature of the transactions are totally same between the uncontrolled and controlled one. However, the royalty payment from country B with respect to the controlled transaction is 100, and with respect to uncontrolled transaction between third parties is 150, which is of course, looking at the circumstances of the transaction, which are all same. There is no difference between the nature of the license award. There is no difference between the payment terms and conditions. All the similarities exist therein. Further, it is the same country A and B where the transaction is taking place, except the pricing arrangement between the parties involved. Looking at this scenario, of course, country B authorities will compare the transactions of the independent enterprise, and of course this pricing will be superimposed on this controlled transaction as well. So under Article 9.1 of OECD MTC Model Tax Convention, a primary adjustment will be made in this transaction, showing the transaction from 100 to 150. Usually such a territory is a low tax jurisdiction wherein MNEs are keeping the most of the profits. Considering that scenario, of course, this adjustment will be taking place, and the primary adjustment under Article 1.0 will be made, and the story will not end here itself. The same adjustment which is required in country A will also be there, which is carried out under Article 9.2 of OECD Model Tax Convention, and that is called corresponding adjustment. After the adjustment being carried out in both the countries, primary adjustment as well as the corresponding adjustment, we see there is no difference between the pricing taking place between the controlled transactions and the uncontrolled one. Let's move ahead. However, these transactions had certain limitations, which in our subsequent slide we will discuss. OECD Model Tax Convention Article 9 describes this nature of transactions, what are they, and we will see this almost the same replication, confirmation of the same principle in transfer pricing guidelines of OECD page 31. Article 1.6 gives same description as is given in Article 9 of OECD Model Tax Convention. I will go through this 1.6 para of OECD. Conditions are made or imposed between the two associated enterprises. Their commercial and financial relationship are same, which may differ those which would have been made between the independent enterprises. So those differences have been taken care of in our previous slide. Then any profit and that would have for those reasons have accrued to one of the enterprises by the reason of those conditions have not been accrued. So here in our previous example, that is what we exemplified, that due to the relationship between the AEs in our previous slide, this amount was not adjusted. So this adjustment was made through primary adjustment, and of course the corresponding adjustment was given to country A. That may be included in the profits of the enterprise and taxed accordingly. So that's what is prescribed by Article 1.6 of OECD TPG given on page 31 in confirmation to the Article 9 of OECD MTC. Here there is an additional elaboration we have added, but for those conditions, means for those special conditions that were not present, then the profit would have been equal to those profits of the independent enterprises with similar conditions. Means, of course, if there would not have been a M&E relationship between country A and country B, the one exemplified earlier would have been the same pricing, 150 rather than being 100, and there would not have been any need for primary and secondary adjustment under Article 9.1 and 9.2 of OECD MTC. Continuing to this, paragraph 1.6 of TPG further says by seeking to adjust the profit by reference to the condition which would have obtained between independent enterprise in comparable transactions in comparable circumstances, i.e. comparable uncontrolled transaction cut. The arm's length principle follows approach of treating the members of an M&A group as operating as separate entities. Now the group entity concept as exemplified in our previous slides has been abolished and both the M&Es are representing their true profit as represented by the third parties to the transactions rather than an in separate part of the single unified business. Because separate entity approach treats the members of an M&A group as if they are independent entities, attention is focused on the nature of the transaction between those members and on whether the conditions thereof differ from the conditions that would have been obtained in the comparable uncontrolled transaction. Such an analysis of the controlled transactions and uncontrolled transactions, which is referred to as comparability analysis, is the heart of the applications of arm's length principle. So this comparability analysis and adjustments finally made is the result of comparability analysis. OECD guidelines give guidance in section D of chapter 1, which we will discuss in our subsequent presentations, which will be issued very soon, and chapter 3. So comparability analysis, through the comparability analysis, authorities or the analysts people come to conclusion that what should be the independent arm's length price approach for a given transaction between the two M&A group. Having said that, authorities do admit that it is not an exact approach. We cannot find the exact match. So definitely it is a exercise to some extent where the judgment is required. The same is confirmed in OECD para 1.13 of TPG, page 33. It says at the end that it is important not to lose sight of those objectives to find a reasonable estimate of an arm's length outcome based on reliable information. It should also be recalled that at this point, transfer pricing is not an exact science, but does require the exercise of judgment on the part of both the tax administration and the taxpayer. Advantages of the arm's length principle. Para 1.8 of TPG describes the advantages of adopting ALP. In para 1.8, it says that arm's length principle provides broad parity of tax treatment for M&A member groups and independent enterprises, because the arm's length principle puts associated and independent enterprise on a more equal footing for tax purposes. It avoids the creation of tax advantage or disadvantage that would otherwise distort the relative competitive positions of either type of entity. In so removing these tax considerations from economic decisions, the arm's length principle promotes the growth of international trade and investment. Subsequent to this para 1.8, a few other paragraphs are there which describes the advantages of the arm's length principle in transfer pricing principles. Thank you for watching us. I'll be coming up with other presentations on the TPG very soon. Keep watching and like my presentation, and let's have your feedback on this. Thank you.